Bill, first, let me just say you had an incredible year. I mean, up 87%, and you had a very strong first quarter as well at the fund. You talk in your letter about frequently rethinking one's assumptions. Tell me how you rethought your assumptions from where we were a year ago and how you're rethinking them even right now in terms of what stocks you're actually picking.
Sure. Thanks, David. Thanks for having me. It's true we had a very good trailing one-year period. That was after an awful first quarter last year in 2020. So I do want to put a little of that into perspective. When we went into 2020, our thought was that the economic level of activity was roughly at a normal level, that even though the economic recovery was getting kind of long in the tooth, the magnitude hadn't been that large. So we felt it was safe to project a continued strong economy. And obviously that all got turned upside down in March with the lockdowns. What I'm really proud of from our analyst team is how rapidly we were able to change our models to reflect a recession consistent with the Fed's severely adverse scenario, and that we tracked pretty well to that over the next year. And I think the other thing that really helped us at Oakmark have such a good year in the trailing 4 quarters is our very long-term time horizon. In times of crisis, I think a lot of investors get very myopic, and you had a lot of discussion about how bad 2020 might be. At our firm, the discussion was much more about what do we think the world will look like in 2025. And that forecast on kind of looking past the economic recession is what allowed us to buy companies that have performed very, very well over the past 12 months as we look forward to a world that's reopening.
Right.
A year ago, we thought maybe we were a quarter away from reopening. I'd still say that today, that we think with the number of people that are getting vaccinated, there's a good chance that in the second or third quarter, we are getting back to something we used to think of in 2019 as normal. A year ago, we could have been off by years. Today, if we're wrong, I think we're only off by quarters. So the window is narrowing, and I think that's a huge positive.
All right, Bill, let's fast forward to the current moment here. You know, when I look at your portfolio, I think financials, at least as the current read, represent as much as 34%. Ally Financial, Bank of America, Capital One, Citigroup, Schwab. None of them reporting today. We've been talking, though, about Goldman, Wells Fargo, and J.P. Morgan. Give me your sense as to why you like financials here.
Well, I think the biggest reason we like financials generally is they have typically traded at about 3/4 of the S&P multiple. The S&P on next year's estimates is about 20 times earnings, and most of the financials today are barely double-digit. Our largest holding, Ally Financial, is expected to make around $6 a share next year, and the stock trades in the upper 40s, so a PE of not quite 8 times earnings. So we think there is a PE move, an increase in PE that's likely for this whole industry. Two of the names that did report today, Goldman and Wells, are both in our portfolio. And I think this quarter serves as a really good reminder, especially with a company like Goldman Sachs, that financials don't just report normal and bad quarters. They also report quarters that are well above average. If Goldman could annualize the quarter they just reported, they'd be making $70 plus per share. That's clearly not our forecast. But with a book value in the mid-200s and an expectation that they could earn 15% on that, we think 15% and 15 times earnings, or a little over 2 times book value, is a very reasonable level for a high-quality financial.
Shepard Smith here. Thanks for watching CNBC on YouTube.